Okay, hi everyone. In this example, we're going to put together cash flows from operating activities. Okay, so the facts appear on the top of the screen. Nash Company reported 144,600 of net income for 2020, and I'm just reading right here, okay? The accountant, in preparing the statement of cash flows, noted the following items occurring during 2020 that might affect cash flows from operating activities. You'll have to pardon my stuttering here. All right, so right off the bat, they've told us what net income is. And with net income, that's how we typically start off the cash flow from operating activity schedules when we're using the indirect method. Okay, so now we can see the 144,600 of net income. And then we've got to go through various adjustments, right? Adjustments to reconcile net income. And we're going to adjust reconcile net income to net cash from operating activities. So we've got 8 items to explore. The first one says Nash purchased 100 shares of treasury stock at a cost of $20 per share. The shares were then resold at $25 per share. Okay. The second one says Nash sold 100 shares of IBM common stock at $200 per share. They acquired these at $150, and there was no unrealized gains or losses recorded on the investment. The third one, Nash revised its estimate for bad debts. Okay, why don't you go ahead and read all of those, and then pause the video, and when you're done reading it, we'll go on. Okay, so normally the first item that we show under net cash provided by operating activities, and by the way, I'm going to show that that's what our next item is. Let me slide down a little bit or show you more of the screen, is depreciation expense. That's usually the first item, and that's usually an add back. And the reason for that is because depreciation expense is included in net income, but it's a non-cash item. So if we included it in net income and we're adjusting to cash provided by operating activities, then that means we need to add back that expense. It didn't involve any cash. Okay, so we'll show the $38,300 is our first adjustment to reconcile net income to net cash provided by operating activities. Okay, now the next item I want to explore is number 2. You can see it at the top of the screen. Nash sold 100 shares of IBM common at $200 per share. The acquisition cost was $150, and there was no unrealized gain or losses. Now, what that means is they recorded a gain on the sale of investments, and that was included in income, right? 200 less 150, selling price less cost times 100 shares was 5,000, and there was a gain. Now, the gain means it was included in net income, but we didn't generate any cash from the gain. Okay, the gain itself. Keep in mind that the net cash is the net cash from this transactions appears somewhere else on the cash flow statement. But in terms of cash flow from operating, we've got a gain. The gain itself is not a cash item to be considered in net income. So since net income was increased by the 5,000 gain, we've got to adjust for that. Okay, and there you see the decrease, the negative adjustment when we're adjusting for net cash provided by operating activities of the $5,000 from the gain on sale of the investment. Okay, next let's focus on item 3. It says Nash revised its estimate for bad debts. Before 2020, Nash's bad debt expense was 1% of receivables. In 2020, this percentage was increased to 2%. Net account for 2020 was $509,600, and net accounts receivable decreased $11,000 during 2020. All right, so the way you think about this is increases in current assets, except for cash, mean that we are funding them, if you will. So a decrease means, oh, we have that much more cash available during the period. Okay, so when we see a decrease of 11,000, that means change to change, we received 11,000 more in cash as a result of our decreased investment in accounts receivable. I think of accounts receivable as an investment, just like cash, inventory, or long-term assets. Okay, so another way of thinking about that is if nothing else were to happen and accounts receivable went down, then you collected the cash. And that means you had a positive adjustment. So that 11,000 adjustment now shows up as a decrease in accounts receivable, and that is a positive adjustment to reconcile net income to cash flow from operating activities. Okay, the next item I want to focus on is number 6. It says Nash Company holds 40% of the Nirvana Company's common stock as a long-term investment, and Nirvana reported $25,100 of net income. Okay, now this sort of relates to consolidations. If we own between 20 and 50% of another company, we normally use the equity method. And when we're using the equity method of accounting for investments, every time that subsidiary has income, we increase our investment account, and we also increase income from our equity investment. But that doesn't mean we receive cash. We're essentially using accrual accounting, accruing the income of the subsidiary. So in this case, what did they tell us? They reported $25,100 of income, and we own 40% of that. So you see the calculation. So $10,040 was in this net income number, but it didn't involve cash. So as a result, we need to remove that. Okay, and there's the 10,040 showing up as a negative adjustment. Okay, now I've adjusted the screen slightly. Let's focus on number 7 now. Number 7 says Nirvana Company. Now that's the company that we own. They're a subsidiary of Nash, at least 40%. Well, not a subsidiary. We have between 20 and 50%, so we're using the equity method of accounting. Nirvana Company paid a total of $1,800 for cash dividends. Okay, so now if Nirvana paid cash dividends, we have to understand equity accounting. With equity accounting, we accrue the income of the subsidiary, but when we collect the cash for it, we then increase cash and decrease the investment account. Okay? So in the previous entry, where we backed out the entire earnings of the company of $10,040, we now have to reverse the portion of that equity adjustment that we already took out. So we already backed out $10,040, but now we're seeing, well, wait a minute, we actually did get $1,800 of cash, or excuse me, we got $1,800 times 40%, the portion that we own, or $720 of cash. Okay, so you see the 720 now being added back in. And the only reason we're adding that back in is we took all of it out in the previous entry. Okay, and from there, all you have to do is run the math of these various adjustments. That would represent your total adjustment to reconcile net income to net cash provided by activities, and then either add or subtract it. In our case, the positive numbers are higher than the negative, so we've got a positive adjustment to reconcile net income to net cash. So we'll show that adjustment, and then we add it to net income, and that would generate our net cash provided by operating activities.